Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 152, and in this episode we are reviewing the performance of the global markets during the 12th week of 2025, and that is from Monday the 17th to Friday the 21st of March. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off by looking at the global economic outlook, where according to the latest estimates from the Organization for Economic Cooperation and Development, global economic growth is said to be lower than previously projected as the ongoing tariff war between the United States and its major trading partners continues to weigh down on economic growth. In its interim economic outlook report, the organization projects that global economic growth will moderate from 3.2% in 2024 down to 3.1% in 2025. The slowdown in growth is attributed to higher trade tariffs as well as increased geopolitical uncertainty, which is weighing down on investment and household spending. And over to the United States, on Wednesday, the Federal Reserve, in line with market expectations, kept its benchmark policy rate on hold, but indicated that further rate cuts were likely later this year. Faced with pressing concerns over the impact that tariffs will have on a slowing U.S. economy, the Federal Open Market Committee decided to maintain its policy rate at the same range of between 4.25% to 4.5%, where it has been since December 2024. Despite the uncertain impact of tariffs, Fed officials said they still see at least another 2 rate cuts of 25 basis points each before the end of this year. In the meantime, the rate-setting Federal Open Market Committee downgraded its collective outlook for U.S. economic growth from the last projection of 2.1% down to 1.7%. Additionally, officials hiked their inflation outlook and projected that core prices will increase at an annual pace of 2.8%, which suggested that the central bank sees an increased risk of stagflation, which is a term used to describe an economy where growth is stagnant but inflation is rising. Staying in the United States, consumer spending came out at a slower than expected pace in February, though underlying indicators showed that retail sales grew at a solid pace despite concerns about an economic slowdown and rising inflation. According to the reading from the Commerce Department, Retail sales increased by 0.2% in February, which was much better than the decline of 1.2% in January, but was still below the Dow Jones estimate for an increase of 0.6%. For your information, consumer spending accounts for about 65% of the United States' gross domestic product. In the United Kingdom, on Thursday, the Bank of England decided to leave its policy rate unchanged as the UK economy contends with uncertainty about global trade policies and the prospect of stagnation for the domestic economy. This policy decision, which was widely anticipated by the markets, keeps the Bank of England's benchmark policy rate at 4.5%. In its official statement, the Monetary Policy Committee voted with an 8-1 majority in favor of leaving the policy rate unchanged, with the one dissenting member voting for a reduction of 25 basis points. In the land of the rising sun, on Wednesday, the Bank of Japan decided to hold its benchmark policy rate steady at 0.5%. And later on in the week, government data released on Friday showed that Japan's core inflation rate beat market expectations as it came in at 3% in February, bolstering the case for further rate hikes by the Bank of Japan. According to economists polled by Reuters, the core inflation rate, which excludes prices of fresh food, was projected at 2.9%, but instead came out at 3%, which was lower than January's rate of 3.2%. Meanwhile, headline inflation increased by 3.7% on an annual basis, which means that the overall rate of inflation has remained above the Bank of Japan's 2% target rate for 35 consecutive months. On Wall Street this past week, the S&P 500 ticked up on Friday, ending 4 consecutive weeks in the red. That was brought on by uncertainty about U.S. trade policy and concerns about a possible economic recession. Friday's trading session was quite volatile, with the major averages coming off their lows after President Trump indicated that there would be some flexibility with tariffs. In closing, the broad market S&P 500 posted a weekly advance of 0.5% to avert a 5th consecutive week of losses and eventually came to a close at 5,667. Meanwhile, the tech-heavy Nasdaq Composite rose by 0.2% for the week to end at 17,784, and the Dow Jones Industrial Average posted a weekly gain of 1.2% to settle at 41,985. For your information, Friday, the 21st of March, is referred to as the Quadruple Witching Day, which is a day when index futures and options, as well as stock options and single stock futures, expire. Goldman Sachs had estimated that more than $4.7 trillion worth of notional options would expire on that day. In the Treasury bond market, the yield on the benchmark 10-year Treasury bond ticked up on Friday amid the ongoing uncertainty about U.S. trade policy and its potential impact on the economy and inflation. Investors are reconsidering the outlook for the U.S. economy given the uncertainty created by the ever-changing policy on trade tariffs, as well as the decision by the Federal Reserve to keep its benchmark interest rate on hold for the time being. The Fed chairman noted that U.S. tariffs may lengthen the process of achieving price stability and have sparked concerns about the possibility of higher inflation and slower economic growth. The yield on the benchmark 10-year Treasury bond rose more than 1 basis point to settle at 4.25%, whilst the yield on the policy-sensitive 2-year Treasury note dipped by less than 1 basis point to end the week at 3.95%. For your information, bond yields and prices are inversely correlated, and 1 basis point is equal to 0.01%. In the energy markets, the price of crude oil rose on Friday, posting its second consecutive weekly gain after fresh U.S. sanctions on Iran and a new OPEC plan to cut output raised concerns over tightening supplies. On Thursday, the United States Treasury Department announced a new round of sanctions against Iran, which are targeted at entities involved in supplying Iranian crude to China. Oil prices were also supported by a new plan by the Organization of Petroleum Exporting Countries that will involve a reduction in output of up to 435,000 barrels per day that will last until June 2026. On a weekly basis, the price of the global benchmark Brent crude increased by 2.2% to close at $72.16 per barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, rose by 1.6% to settle at $68.28 per barrel. In the precious metals market, the price of gold fell over 1% on Friday, mainly due to a stronger dollar and profit-taking by traders. Despite this dip, bullion remained on track for a third consecutive week of gains, driven by lingering geopolitical and economic uncertainties, plus the prospect that the Federal Reserve will cut interest rates later this year. The Federal Reserve has projected at least 2 rate cuts of 25 basis points each before the end of this year, and traders are also pricing in about 71 basis points of easing this year, with the first rate cut fully priced in for the month of July. Gold is traditionally viewed as a safe haven investment, especially during times of economic uncertainty, and usually thrives in a low interest rate environment since it doesn't provide a regular yield like a bond. The price of spot gold hit an all-time peak of $3,057 on Thursday and was up marginally by just 0.7% for the week to eventually settle at $3,014 per ounce. In the cryptocurrency market, the crusade by the Securities and Exchange Commission against the crypto industry now appears to be over. The final chapter closed on Wednesday when Ripple announced that the Securities and Exchange Commission had officially dropped its 4-year-old lawsuit against the company. Various other crypto companies and exchanges have previously also seen lawsuits or investigations by the Commission either dropped, resolved, or put on hold. For your information, Ripple is the leading provider of digital asset infrastructure for financial services, and XRP is the native cryptocurrency for the Ripple network, which seeks to integrate with the traditional banking system. Following the above announcement on Wednesday, the price of XRP jumped by about 11% to settle at $2.56 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenyan shilling dipped slightly versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.38, compared to 129.43 that was recorded the previous week. Meanwhile, the sterling pound was priced at 168.14 and the euro was valued at 140.97. And on the regional front, one Kenyan shilling was changing hands for 28.33 Ugandan shillings and 20.56 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.88. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves decreased by $54 million for a grand total of $10 billion, which is equivalent to 5.1 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, the interbank market was sufficiently liquid during the week and was also supported through open market operations, which remained active. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this was relatively stable at 10.64% compared to 10.69% the previous week. And in terms of volume, the average value that was traded in the interbank market, this decreased to 11.6 billion shillings, down from 19.5 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 21.9 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 20th of March, and the central bank received bids totaling to 30.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 129%. The central bank, however, ended up accepting only 24.4 billion shillings, and the results of the auction were as follows. The 91-day rate fell by more than 7 basis points to average out at 8.84%, whilst the 182-day rate dipped by about 3 basis points to level off at 9.08%, and the 364-day rate was lower by just 1 basis point to settle at 10.46%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the April Treasury bond issue, in which it is looking to raise a total of 70 billion shillings for the stated purpose of budgetary support. The central bank is inviting the public to submit their bids for the following 3 treasury bonds whose terms and conditions are as follows. The first bond is a 15-year bond, reference number FXD1/2020/15, with 9.9 years left to maturity and a coupon rate at 12.75%. The second bond is another 15-year bond, reference number FXD1/2022/15, with 12.1 years left to maturity and a coupon rate at 13.94%. And the third bond is a 25-year bond, reference number FXD1/2022/25, with 22.6 years left to maturity and a coupon rate at 14.18%. These bonds are now open for sale until Wednesday, the 2nd of April, when the auction will be held. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NASI gaining the most by 0.5%, whilst the NSE 20, the NSE 25, and the NSE 10 gained by 0.4%, 0.2%, and 0.1% respectively. This takes the year-to-date performance to gains of 9.1% for the NSE 20, 3.9% for the NASI, 2.2% for the NSE 25, and 0.6% for the NSE 10. The market's performance was driven by gains recorded by large-cap stocks such as Standard Chartered Bank, Cooperative Bank, and NCBA Bank, which increased in value by 12.3%, 6%, and 1% respectively. This performance was, however, weighed down by losses recorded by other large-cap stocks such as Equity Bank, Absa Bank, and KCB Group, which declined by 2%, 1.3%, and 0.4% respectively. Up next is our topical issue, and this week we're looking at the recent increase in Kenya's foreign exchange reserves. As at the 13th of March 2025, data from the Central Bank of Kenya shows that the country's foreign exchange reserves increased by an astronomical $913 million to hit an all-time high of $10.05 billion. This level of reserves represents about 5.1 months of import cover and by far exceeds the central bank's statutory requirement of maintaining at least 4 months of import cover. In February 2025, Kenya floated a new Eurobond of $1.5 billion, whose proceeds were to be channeled towards buying back the 2019 Eurobond for $900 million. This buyback was aimed at easing the burden of repayments falling due within the next 2 years and extending the maturity and repayment of the Eurobond out to 2036. However, investors only agreed to sell back about $580 million, leaving a balance of $920 million, which explains the increase in foreign exchange reserves. The Treasury has also confirmed that this balance of $920 million has been earmarked for the repayment of syndicated commercial debts during the course of this month. For your information, foreign exchange reserves are held as a safety net to ensure the availability of foreign exchange to meet the country's external debt obligations. The reserves are also used to intervene in the domestic foreign exchange market when the central bank deems it necessary to reduce volatility in the dollar-shilling exchange rate. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories. That is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, without data, you're just another person with an opinion. Think about it. Thank you, and God bless.